In this piece, I'm going to define monetary policy in, I think, pretty great detail. To do so, I'm going to provide a timeline of the United States banking system. I've found that this is the most palatable way to really convey this material. Students actually, believe it or not, do seem to like it. So here we go. Monetary policy, the thing that we are illuminating here, these are efforts aimed at affecting economic variables through the supply of money. Monetary, root word is money. So when you hear about the money supply or interest rates, we're going to explore this. You'll see that effectively we're talking about the same thing. The supply of money and interest rates are effectively the same. And these are the tools of monetary policy, which is, again, just as a reminder, that's different from fiscal policy. They both might sound like 10-cent economic terms, which I suppose they are, maybe 6 cent. But they have very different meanings. Fiscal policy, again, is taxes and government spending. Monetary policy is about the money supply and interest rates. Now, to get to how that's conducted, let me run through this timeline. It's just a brief timeline. It doesn't go back too far. It only goes back to July 27th, 1694. In 1694, on July 27th, the Bank of England was granted a royal charter by William III, quote, to regularize the monarch's finances. To regularize means to avoid fluctuations in the value of. This scheme, and that's being used in the British English sense of the word, not the American English sense of the word. Scheme just means a plan in British English. To us, it sort of indicates something sneaky, right, or sneaky. No. So the scheme was invented by a Scotch promoter named William Patterson. You don't have to know that. The scheme was to create a bank with a, quote, fund for perpetual interest. Fractional reserve banking was created. Fractional reserve banking was created. Just lock that in there, remember, for just a short-term memory for just a second. Along with the radical monetary concept of a monopoly bank, which would create money for loans that would never be repaid. We now refer to this, and this by we I mean all English-speaking countries, as a lender of last resort, I believe, is what we mean by this monopoly bank. As times change, terms change. There are a couple things going on there that are really a big deal if you think about them. I know that sounds like a bunch of long words about something in ancient history, but put yourself in the shoes of people at that time. Two things happened there on July 27, 1694, which would be a very big deal to today in our economy, where we all participate in the economy, believe it or not, way more than a lot of people did in 1694. This would have, a change like this would be very dramatic for us. Two changes in here. Okay, the first is this fractional reserve banking. Fractional reserve banking. The term does describe what it means. Let's investigate. Prior to 1694, as I understand it, in Europe, banking was something like this. If I had money, I would go to a big, strong man, and I would say, I need for you to secure my money. That was the idea of a bank. And a big, strong man, meaning protected in some kind of a lockup, because the idea is to protect it from thieves. So people who traveled around Europe for whatever reason would go to big, strong men, and they were not called banks, I don't think, but these people who would protect their money, lock it up. That's why I'm calling it a bank. And that way, when they came back through that area, they could get some money that was theirs, and it would be locked up there with this person. And it'd have to be a big, strong person, to keep it from being stolen. That's all it's about. People hitting each other or stabbing each other and taking money. So you want the toughest person around to protect your asset. that didn't have the name, but generally that was a bank. But then in this year 1690, you don't have to memorize the year, 1694, fractional reserve banking comes along, and this is all, gotta put yourself in their shoes. Going from that world that I just described to this world is a big jump in people's trust and feelings about the economic world around them. Because fractional reserve banking means when you put your money there at this bank, they're not going to keep it all there anymore. They're going to only keep a fraction on reserve, and they're going to lend some of it out to someone else. In a world where you were accustomed to your stuff being protected and just locked away, you are now told some of that will not be there. It will be lent to someone else. You will still have on paper that it is yours, and you will still have legal claim to it. It just won't all be there. A fraction of it will be on reserve. You know, if you let yourself think about what that would be like, that's a big deal. That is a big change from the world you're used to. And of course, that can work because as long as you don't all come back at the same time and request your money, why should it all be there? You know, here's this guy in the woods in Austria, big strong guy who just has everybody's money locked in his vault, and he protects it from thieves, and everybody knows not to mess with him. And the customers who have that money locked in there, they only come by every few months, one every few months, and then somebody else makes a deposit anyway. So from that point of view, why not lend some of it out and collect interest on it? That way when somebody comes, you still have what you need to cover that person's withdrawal. So that's what fractional reserve banking does. Pretty radical change. And this idea of this monopoly bank, or what I'm calling a lender of last resort, this is a pretty big deal too. And it comes back our way again in the United States here about a couple hundred years later. And the idea here is, if the big strong guy in the woods messes up, more people come to withdraw, or maybe he gets clunked in the head and does get robbed. This idea of this lender of last resort, or a monopoly bank, a larger bank to, how is it phrased, create money for loans that would not be repaid, will lend him money to cover those losses. And this invites a lot of doubt, because it's called moral hazard. When there is a safety net under people or institutions, they tend to take greater risks than they otherwise would, because they know there's something there to catch them. And since they're willing to take, they tend to take greater risks than they otherwise would, the net tends to be needed more often. That arrangement, any kind of insurance, develops this arrangement of moral hazard. And a lot of people have a very strong distaste for this, because we know these catching people when they make mistakes has costs. And you might want to catch people when they more make mistakes that were unavoidable. But when the safety net is present and people know it, they become less unavoidable and more of this moral hazard, where people were taking risks that they otherwise wouldn't have taken without the availability of the safety net or some lender of last resort or some kind of insurance. So pretty big stuff happened in the late 1600s. Now we can skip ahead to December 23rd, 1913. We're back in the United States now. On December 23rd, the Federal Reserve Act was created. It was also known as Glass-Steagall. It was ratified by Woodrow Wilson 1 hour after passing in Congress. Very controversial bill. Think about that date, December 23rd. What's the significance of that? In the whole calendar year, December 23rd is what? That is 2 days before Christmas, 1 day before Christmas Eve. And you're talking about back in 1913. People were not, the congressmen then, were not going to, was it Dallas and Reagan and zipping on home in the evening? No, they were getting on trains and traveling back to their respective states for the holidays. And that's December 23rd. When you pass legislation at any level of government, if the charter of the government is generally well written, you have to have what's called a quorum. You can't just say two United States senators cannot get together and say, hey, we're in session, and pass a law. It doesn't work that way. They have to have a certain number of people actually present. And I believe in the United States Senate it's 60, but I might be wrong about that number. Don't hold me to that. But it's usually it's along the lines of 60% must be present to pass a bill for a quorum in whatever legislative body. That's usually what it is, 60s. And sometimes that can be used to pass bills that otherwise wouldn't pass. Because if you can get the right 40% to not be present, and you have the correct, I could do the math here, but 40% who will vote for it, the other 20% who is there can't win. So 60% might oppose it, but if 40% who oppose it have gone home for Christmas, and only 20% who oppose it are still there, but the 40% who support it are still there, you have enough people there for a quorum to go ahead and hold a session and to pass a bill, even though only a minority of 40% actually support the bill. December 23rd, 1913, making it through Congress and getting signed by a president, that's pretty fishy. Why would something be pushed through like that? Because it's controversial. Because it wasn't well supported. Why wasn't it well supported? Because what it does is, and this is a quote from the original documentation of the Federal Reserve, to provide for the establishment of Federal Reserve banks, to furnish an elastic currency, it means responsive, to afford means of rediscounting commercial paper, we don't really care about that for our purposes, to establish a more effective supervision of banking in the United States, and quote, for other purposes. So they've invented this sort of super bank in 1913 that is a lender of last resort for other purposes as part of their charter. That's a lot of power. And it also has this aspect of being a lender of last resort and facilitating moral hazard. Because when banks have a place to go when they screw up, they're more likely to screw up. And a lot of people don't feel that good about that. So the Federal Reserve Act was passed on December 23rd, 1913. But all that negativity in there, laced in there, just keep in mind, we've made it 100 years, well over now, 107 years. The Federal Reserve is going strong. Just trying to make this a little interesting. So that's when it happened and what happened. And then, as time passed, other things happened. In the world, in the late 1800s, a significant event was occurring, and that was World War I. But World War I ended. And during World War I, if you think to your history classes, the fighting was going on in the fields in Europe, and it was trench warfare. And they had all these trenches dug in, and they would move very slowly back and forth across the fields, the soldiers killing each other, fighting, whatever, right? And it took place, if you've ever dug a hole, you know you don't want to dig a hole in the woods. You dig a hole in fields. It's less fewer roots. It's better for digging. And that's where most of the battles were taking place, was in the fields of Europe. What's that mean for agricultural production in Europe? It's real low, because they're out there in the field shooting each other. There's no growing corn going on there. What's that mean about the demand for U.S. agricultural products? It's very high, because the other side of the Western world isn't producing. So the demand is all for the whole world, or not the whole world, but the Western world is entirely focused on U.S. agricultural production. What's that mean to the prices of goods, of the grains from the United States? Way up. Farmers were borrowing on high incomes of the 19-teens during World War I. But then the war ended. And they got those dead bodies and all those munitions out of the fields in Europe and began agricultural production back in Europe again. So, when European farm production was restored to pre-war levels and foreign demand for agricultural products disappeared, prosperity changed to adversity. Prices fell and faith in the banks plummeted because those farmers borrowed money on their high levels of income during the war, and the banks lent them money on their high levels of income during the war, but that income went away when the war ended. So the banks got hurt. And as the banks got hurt, here we go again, runs on banks and panics forced 20% of the nation's banks to close between 1921 and 1929. You heard of the Roaring Twenties. I know you have. That was a city thing. In the 1920s, U.S. agriculture, which was a bigger component of the economy, a much bigger component of the economy, was already not doing well. Your textbooks kind of gloss over that, I think, your history textbooks. The Roaring Twenties was an urban thing. The rural thing was already in bad shape. In fact, 20% of the banks closed because of the bad economic shape in the rural communities around the United States. I bet you probably didn't know that. The farm pressure lingered in the upper Midwest until 1927. Conditions improved, only to be reversed by the stock market crash in October 1929. Between 1929 and 1933, about 10,000 banks failed nationwide. And sadly, I have apples and oranges in this timeline that I put together. I don't know what percentage that was. In March 1933, President Roosevelt declared a bank holiday to assess the national monetary situation and develop a remedial plan. The Emergency Banking Act, passed on March 9th, gave the executive branch control of the banks and authority to reopen banks in sound condition. Now, we like to get upset today about things that happen in the government, close downs and the election, and a president not conceding to an election. And we like to think that the sky is falling all the time in our world. Listen to what just happened there. The federal government gave one branch of the federal government. Remember, we're supposed to have three branches that have checks and balances. Gave just the president, the executive branch, oversight of all the U.S. banking. One branch, one person. Furthermore, they called it a bank holiday. Now, we hear political bills. They get these names today that are kind of like the they have these nice names, and suddenly I'm going blank on what they are, and I don't want this video to be too long. They called this a bank holiday. You know what a bank holiday was? That was when you went to the bank and it said, "We're closed. You can't get your money out. We're not allowed to open and give it to you." Does that feel like a holiday? I don't think so. So the stuff that we go through has been gone through before, and maybe in ways that we can barely even imagine. Just imagine being told the executive branch is taking control of all banking, including your money that was in the bank, and they called a holiday and locked the door so you can't get it. That's what happened in 1933. Then in 1933, the Glass-Steagall Act came along and regulated banking significantly, which was only repealed in the 1990s. And then in the great financial crash of 2007 and 8, there was a lot of talk about reinstating Glass-Steagall from 1933, that act. And parts of it were reinstated as part of the Sarbanes-Oxley Act, as a matter of fact. 1935, the Banking Act of 1935 restructures the Federal Reserve System, introducing the basic structure that exists today. The Treasury Secretary and the Comptroller of the Treasury no longer serve on the board. It was taken away from the executive branch 2 years later. And we have an autonomous Fed, independent of the government now. And most economists would say, and that's a good thing. And then in the 1950s, a couple things happened. MICR ink recognition came along, allowing for automated check processing. The ink on checks is a particular kind of ink that can be read by machines, which means money can turn over faster than ever before. And open market operations. Open market operations became the primary tool of the Federal Reserve. Open market operations are what we're going to cover, well, we could say for the rest of the semester. That's an important thing. Remember the term, and we'll explain it in another video, open market operations. And that completes my timeline of banking in the United States. And that thing that I just described again, open market operations, is what I'm talking about. That's where we're going to really start exploring what that is, what the other tools of the Fed are, and how that particular tool really works, because that's going to be very important for your understanding for this class, and a lot of what you hear and see in the news, really, you'll think about this for the rest of your life.